On February 8, 2026, the Nasdaq trap door swung open, plunging over 10% in a single session and vaporizing $1.5 trillion in market cap faster than you can say AI bubble. Tech giants like Nvidia, Apple, and Microsoft led the waterfall, with retail investors caught flat-footed while the smart money had already repositioned weeks earlier. Let that sink in for a second. $1.5 trillion gone in hours. That's more than the GDP of Australia, erased because the market finally woke up to the reality that the AI hype train was running on fumes. But here's the dirty secret the mainstream media won't tell you. This wasn't some random black swan event. It was an engineered flush, orchestrated by a perfect storm of overvaluation, sticky inflation, and institutional repositioning. And if you're not paying attention, you could miss the rebound that's already brewing under the surface. Let's break this down step by step, because most people are still staring at the headlines like deer in headlights, thinking it's just volatility. No, this was a reckoning. First, zoom out to what set the stage. For the past 2 years, the Nasdaq had been on rocket fuel, up over 150% since the 2024 lows, fueled by the AI gold rush. Companies like Nvidia were trading at 100 times earnings, with valuations assuming every human on Earth would soon have their own personal AI butler. But here's why this matters. Valuations like that aren't sustainable without endless cheap money, and the Fed's been slowly turning off the tap. Remember, inflation didn't die in 2025 like the bedtime stories from CNBC promised. It lingered like a bad hangover, with core CPI stubbornly above 3%. Then, on February 7th, the day before the wipeout, we got the January jobs report. 450,000 jobs added, way hotter than expected, and wage growth ticking up to 5.2%. Boom. The bond market freaked out. Yields on the 10-year Treasury spiked to 4.8%, and futures markets slashed the odds of a March rate cut from 80% to under 20%. Suddenly, the discount rate for all those pie-in-the-sky AI profits got a lot higher, and the house of cards started wobbling. Think of it like this. Imagine borrowing money to buy a Ferrari at 0% interest. It's a no-brainer. But crank that rate to 5%. And suddenly you're questioning if you really need the speed. That's what happened to tech stocks. Higher rates mean future earnings are worth less today, so the multiples got crushed. Nvidia, which had been the darling with its chips powering every AI model, dropped 15% that day alone. Apple shed $200 billion in market cap, because investors realized their Vision Pro headset wasn't going to replace iPhones overnight in a world where consumers are squeezed by inflation. But wait, it gets juicier. The real trigger? A cascade of forced liquidations from over-leveraged players. Hedge funds and family offices had piled into tech via options and margin debt, with total margin balances hitting a record $1 trillion by January 2026. When the first cracks appeared, like Tesla missing delivery targets by 20% in their Q4 earnings 2 weeks prior, the algos kicked in. Stop-loss orders triggered, gamma squeezes reversed, and it turned into a full-blown flush. We've seen this movie before. It's straight out of the 2022 playbook when the Fed hiked rates and crypto imploded, or even the 2000 dot-com bust when pets.com went from hero to zero. History doesn't repeat, but it rhymes. Take the dot-com bubble. Back then, internet stocks were valued on eyeballs instead of profits, just like today's AI plays are valued on parameters in models. Cisco Systems traded at 200 times earnings before crashing 80%. Fast forward to now, Palantir was at 150 times sales before the wipeout. Or look at the 1987 Black Monday crash, a 22% single-day drop triggered by program trading and portfolio insurance, much like today's high-frequency bots amplifying every tick. And don't forget 2008. Lehman Brothers' collapse started with subprime, but the real pain came from the deleveraging spiral. Here in 2026, it's AI overpromise meeting economic reality. Now here's the part most people miss. The smart money saw this coming miles away. BlackRock quietly trimmed their tech exposure by 15% in January per their latest 13F filings. They didn't announce it with fanfare. They just repositioned while retail was still FOMOing in. JP Morgan closed out massive short positions on the Nasdaq futures right before the jobs data hit, locking in billions. Institutions always move before the headlines. They follow the footprints of economic data, not the noise. While CNBC was still pumping soft landing narratives, the bond vigilantes were already pricing in pain. Quick note before I go further, if you're serious about spotting these moves early, you need to think like the top 1%. That's why I created the Buffett Academy. It's my exclusive community where I share weekly videos breaking down exactly what the institutions are doing, the stocks I'm buying right now, and my millionaire blueprint to build wealth like Warren Buffett. Spots are limited and the window closes fast. Check the pinned comment below for the link. It's not hype. It's the tools to win in markets like this. Back to the wipeout. The mainstream media is telling you it was unexpected volatility or geopolitical jitters from the ongoing Taiwan tensions. But that's the neat, clean version they feed you to keep uncertainty alive. The real question is, why the vagueness? Because admitting it was a valuation reset would expose how overinflated everything was. They want you terrified so you stay glued to the screen, but here's what actually happened. It was a classic capitulation event. Volume spiked to 20 billion shares, the highest since 2020, with capitulation indicators like the VIX exploding to 45. Retail got flushed out, selling at the lows, while the big boys started nibbling. Let me explain the AI angle with a simple analogy. It's like a circular economy where companies dig a hole and fill it back in to book revenue. Big tech spends billions on Nvidia chips to train AI models. Nvidia reports blowout earnings, stock soars. Then those same tech firms use AI hype to justify their own valuations. But when growth slows, like OpenAI's revenue plateauing at $3 billion annually despite the hype, the circle breaks. Add in regulatory whispers. On February 5th, the EU antitrust probe into Microsoft and OpenAI deepened, hinting at potential breakups. That spooked the algos, and poof, $1.5 trillion gone. Another historical parallel. The 2011 precious metals crash after the debt ceiling drama. Gold peaked at $1,900, then plunged 20% as liquidity dried up. Same here. Liquidity in tech evaporated when rates rose. Or the 2017 tax cuts. They juiced stocks short-term, but led to buyback binges that left balance sheets leveraged. Fast forward to 2026, share buybacks hit $1.2 trillion in 2025, mostly in tech, leaving companies vulnerable to rate shocks. So, why the Nasdaq specifically? Because it's 40% tech-weighted, unlike the Dow's industrial tilt. The S&P 500 only dropped 4% that day, but Nasdaq bore the brunt. Energy and financials actually rose. Classic rotation. Here's why this matters for you. This wipeout isn't the end, it's the setup for the next leg. Valuations are now back to earth. Nvidia at 40 times earnings instead of 100, and the Fed might pivot if unemployment ticks up. But don't wait for certainty. By the time CNBC explains the rebound, the easy money is gone. Position before it becomes obvious. I'm loading up on quality tech that's been unfairly punished. Think undervalued AI enablers like semiconductors with real moats or cloud providers with sticky customers. Avoid the hype chasers. Focus on free cash flow kings. And remember, diversification isn't just stocks. Sprinkle in some bonds now that yields are juicy at 4.8%. One more thing. The flood of money from sidelined cash, $6 trillion in money markets, could rocket fuel the snapback. We've seen this in 2020 post-COVID crash. Nasdaq down 30%, then up 100% in a year. History rhymes. Quick promo. In the Buffett Academy, I just dropped a members-only video on the exact 5 stocks I'm buying post-wipeout, with entry points and why they're Buffett approved. It's about thinking long-term, not chasing memes. Pinned comment has the sign-up. Don't miss it. This is how you turn wipeouts into wealth transfers. Now, zooming out further, this event exposes the myth of passive investing forever. ETFs like QQQ amplified the pain, with outflows hitting $50 billion in a day. The key is active management in frothy markets, spotting when the music stops. Criticizing the narrative again, headlines screamed, "Tech Armageddon," but they ignored the positives. Unemployment is still 3.8%, corporate profits up 5% year over year. They want you selling in fear so institutions can buy cheap. Follow the money, not the fear. Another analogy, negative rates in Japan were like paying back less than you borrowed. It propped up zombies. Here, zero rates propped up zombie tech unicorns. Now, with rates normalizing, only the strong survive. Historical nod number 4, the 1970s stagflation era, when tech, then semiconductors, got hammered before booming in the 80s. We're in a similar transition, from hype to utility in AI. So, how to win? First, cash is king short-term. Park in T-bills yielding 5%. Second, buy the fear in tranches, 25% now, more on dips. Third, watch the Fed's dot plot in March. If they signal cuts, it's game on. Urgency alert. The rebound window closes fast. Institutions are already dipping toes back in. Retail waits for all clear, missing the bottom. Final thoughts. This $1.5 trillion wipeout was painful, but it's a gift for prepared investors. Learn from it, position smart, and thrive. If you got value from this, smash that like button. It helps the algorithm spread the truth. Subscribe and turn on notifications so you never miss these breakdowns. Share this with a friend who's an investor. They need to hear the real story. And check the pinned comment for Buffett Academy, exclusive insights, my portfolio picks, and the blueprint to millionaire status. Let's build wealth together. See you in the next one.